Okay, module 6, drawdown control, what to do in an emergency. We covered in the last module how I get in and out of the market without stop losses, without physical stop losses I should say, and occasionally you're going to get situations where price will squeeze you and it will keep going in one direction over and over again, and every entry you take will just turn around and go back the other way. That's going to happen. This is what normally happens in the market. We're used to getting stopped out in these situations, but now we're going to find ourselves in deep drawdown. So we need to have a plan in place to deal with drawdown when it gets to an uncomfortable level. All right, and that's what we're going to talk about in this module. So you're going to be in drawdown most of the time. Get used to it. This is the way that trading works when you're trading like an institutional trader. So you're going to get into the market and you're going to build a position over time. You're not going to just get in and get out straight away, which is what you're used to doing. It's going to be a little bit alien initially when you start doing this, which is why I want you to start doing it with very, very small lot sizing to get used to what happens, how the drawdown builds and what happens in the market with the waves and the cycles and how it gets you out into a profit. Okay, so you've got to get used to being in drawdown and accepting that every single day you're going to be in the red, probably, and you're going to be banking very small amounts of money constantly. All right, so your job, as I said, is to make that drawdown smaller every day if you can, and make that profit bigger every day if you can. Okay, so my open trades P&L is virtually in drawdown all the time, but my daily P&L is very rarely ever red. All right, so what we're doing is we're just using these cycles to extract money out of the market. Your new job is to make the green more green and the red less red every day. So basically, as I just said. So your only focus from now on is to bank profit on a daily basis. So every time you get a decent amount of profit and you can see a trade's gone in your direction, you take it. And you're going to use that, if you need to get rid of some of that red in your ledger. All right. So when do we start drawdown control? Drawdown control becomes uncomfortable at a certain level. So you remember in the last video we put a plan into place where we were going to take 3 or 4 positions and we planned those out with pending orders. So we knew what was going to happen and we calculated what sort of drawdown level we're going to be in when we're wrong on a trade. As I said previously, the ideal trade for me is I get into the market, maybe go into a little bit of drawdown for a couple of hours, and then it shoots off in my direction and hits my TP. That is the goal every time we get into a trade, is to be right. Okay, nothing's changed. We want to get into the market with one position, be right, hit target and get out. Okay, when that doesn't happen, we know comfortably we can go down to certain levels before we start to get uncomfortable. When we get uncomfortable, we start to get into drawdown. Now the thing to understand here is your level of uncomfortableness, if you like, may well change from your initial idea. So if you had an initial idea where you said, I'm happy to go into 300 or 500 pounds worth of drawdown on this currency if it goes against me, but in the meantime what's happened is you've banked £2,500 worth of profit in a week, you might get to that level of 500 pound in drawdown, which was initially your uncomfortable level, and now you're really comfortable with that 500 because you got 2,500 in the bank. You can see that your RSI is really low and it's really due a good pullback in your direction. There's a beautiful target there with a large propulsion candle, so you're now actually feeling not so uncomfortable. So your level of uncomfortable is going to change depending on how your week, your day, your month or your hour, even if you're scalping, is going. All right, so we introduce drawdown control when we're feeling uncomfortable with that position or that currency at a particular time. All right, so when you get uncomfortable, there's usually reasons for it. One of them is obviously going to be that price has moved way too far against you and you were really wrong in a trade. Another reason you're feeling uncomfortable is because you've got too many pairs on a particular currency. All right? Remember our 2 currency rule. If we take a US dollar yen and a US dollar CAD long, we can't take any more US dollar trades, like a pound US dollar or something else. All right? If you do, your level of drawdown is going to accelerate faster than you would hope, and you're going to get uncomfortable on that currency a lot more than you would have done if you'd just taken 2. The other reason we can get really uncomfortable is because we've got far too much lot size on. which brings me back to the previous module. Did you plan your trade properly? Okay, so just make sure that when you're feeling uncomfortable, when you get there, you identify why. Why are you uncomfortable? Is it just because you were wrong? And if that's the case, absolutely fine. Is it because you made a mistake? Did you get into too many pairs? Did you break one of your rules? Did you not plan this trade properly? Did you miss a level? If you did those things, just learn from them. Write them down in a journal or on a pad in front of you. And just make sure you try not to make those mistakes again. One of the big things that will make you progress as a trader and make you learn is by making mistakes. And you're going to make mistakes. I still make mistakes to this day. It's just in our nature. We're going to make mistakes. But the important thing is when we make them, we learn from them. We understand why they occurred and we come up with a solution to make sure that they don't happen again. The other reason obviously you get into drawdown, as I've discussed, is you were completely wrong. Okay, not temporarily wrong with your entries, you were just wrong. Basically, something's happened, this thing turned around, it's tanked, it's gone completely the wrong way, all right? So that's why we're getting into drawdown, and that's why we're going to need to initiate drawdown control, all right? So here, I've got an example of a P&L here. So this is a week's P&L, all right? So you can see that on this particular week, I bagged about 1,800 roughly, and it got down to Friday, and I'm sitting with 468 in drawdown. Okay, so I'm totally comfortable with that as a drawdown level. I got 10 positions on, 1.69 lots running. I've got 5 longs, 5 shorts. Obviously, this is going to be on different pairs, but I'm comfortable with this level. Okay, for my account size where it is at the moment, I mean, this is just a portion of my account, but that's 0.5% for me, less than 0.5%. I'm running a big account. Okay, so I'm comfortable sitting there, and that's the important thing. You need to be aware of your comfortableness. Which level is the bit that means, right, I need to start thinking about reducing this now, okay? So let's have a look at reducing your pain. Your level of pain is different to mine, okay? And that level of pain is going to be based on your experience. It's going to be based on your overall trading experience and also your experience trading in this way. And it's going to be also controlled a lot by your account size. Okay, so if you've got $1,000 account and you're 100 in drawdown, you're 10% in drawdown, that might make you feel uncomfortable. If you've got a $1,000 account but you've got $50,000 sitting in a savings account in the bank, you may not feel uncomfortable with £100 in drawdown. I don't know, but what you need to think about is when you feel uncomfortable personally. All right, it's going to be different for every trader. I don't know what that is, and only you can feel when you're getting uncomfortable. And all I would say is that is the point when you start to look at drawdown control. All right, you need a mechanism or a rule set to trigger this, to tell you that you are in pain and that you need to start taking some losses on these wrong positions. So how do we do this? All right, basically what we're going to do is we're going to use the profits we've gained every day to reduce the pain on the pairs we were wrong about. Okay, so if we've got this drawdown, this red on our ledger constantly, okay, we need to, when this gets to a certain point, reduce the speed at which it happens. So if you've got more lots and more lot sizing and more positions on and they go against you, that rate of drawdown, the speed that it gets from $100 in drawdown to $500 to $1,000 in drawdown, that is going to be exponentially faster if you've got more positions on that go wrong. Okay, so the speed of drawdown is something that will also affect your pain and your uncomfortableness when you're sitting in your trades. This is a business, and you need to make business decisions yourself, and this is one of the reasons I disagree a lot with signal services and with following other traders' trades, because I will sit there in a trade, take a trade to go long, be wrong 3 times and get in 3 more times and feel absolutely fine with that. But if you're following what I've done, you may feel completely different and uncomfortable, and you'll take actions which will be different to mine. And that's why no 2 traders are going to get the same results out of a signal service. All right, and EAs, you know, you can put an EA in the market, but somebody's going to intervene with that EA at some point, whereas other people won't, and you'll get different results. Right, so look at this as a business. You've got to make decisions yourself, and you've got to be happy with whether you're right or wrong. Okay, your daily profit is what keeps your little people in your head happy. As a business, I want to make sure that I put 150 to 250 pounds a day into my P&L. Okay, that is my business goal every day. Now my goal every day, if I get to 500 or 600, is to look at my loss, look at my drawdown and think, right, okay, I've made 500 today. Maybe I'll use a little bit of that and I'll take some of these positions off to make myself a little bit more comfortable. Keep my business comfortable, ticking over and happy, all right? Taking losses is required to reduce the speed of drawdown, as I've said, and it helps us sleep better at night. I'm not sure if any of you hold over the weekends. I hate weekend holds, all right? Because you can get gaps in the market. It doesn't happen very much in Forex these days because there's so much liquidity, and it's got to be a really big fundamental thing that happens over a weekend to make a big gap appear, and also for that gap not to get filled. We're going to talk about gaps in the next module. That's one of our strategies. But I don't like holding over weekends just because I don't like going into the weekend with £1,000 or £1,500 in drawdown on my account. I don't sleep well because I'm thinking, what happens if there's a massive black swan or gapping event over the weekend that I've got no control of? When I wake up on Monday morning, that thing's going to be possibly 3 or 4k in drawdown. I don't want to be in that situation, so I will always try and get my position size of my drawdown down as small as I can on a Friday. And you'll often see in my P&L, my Friday profit is quite often a little bit lower or sometimes a lot lower than the rest of the week because I'm using the profits I've made for the week just to reduce the pain I've got holding over into the weekend. All right? And I say the word pain, it's not pain, it's level of drawdown. If I've got £1,500 in drawdown going into the weekend, I'm not really that worried about it, to be honest, but that's my level of account. Okay, it's all to do with the percentage of your account, okay, and how much you've got in your account when you go into drawdown as to what your uncomfortable level will be. All right, but what we're going to do is we're going to use our profits to negate some of this pain. A quick entry rule I may not have mentioned, and this is obvious to me, but on editing the last module I realised that I hadn't mentioned this. Okay, when you trade a grid or a basket, your rate of drawdown is directly affected by the number of entries that you have. Okay, so one thing I wanted to cover is you need to make sure that when you get in, you don't get in too close with your entries. All right, so if price moves against you and you've got 4 entries in a particular currency, your rate of drawdown will be twice as fast as if you'd have had 2 entries. Yeah. So what I'm trying to say is you need to pick your entries wisely at areas that make logical sense and try not to deviate from them. If you see a big bullish candle going in, all right, in between 2 levels, so in between a trade you've taken and one you've planned, the temptation is to go, this looks like this is the reversal point. It might not get down to my pending order, and to get in quickly now. Right? It's not a good thing because if that comes against you and hits your next pending order, instead of having 2 positions on, you've now got 3. Okay, so you're over leveraged on your initial plan. So what I would say is plan your trade and stick to your plan. Okay, don't alter the plan once you get into a trade, because the temptation is you will start to get in too quick to try and get out of a position in drawdown, especially initially when you start doing this, and you will suddenly start to over leverage. Okay, if you get a signal to go long and the last entry you made was around the same area, don't get in twice just because you've got a signal there again. Let me just quickly show you what I mean by this. So let's say, for example, we have taken a trade. Let's say we took a trade on this this breaker here. Okay, so we took a long here, right? And our next planned entry was down here. Yeah. So as price got broker, we got the broker here and we entered into the market, it pulled back against us. Okay, then put in this nice bullish engulfing. Now if our next planned entry level was going to be here and we got in on this one, yeah, you can see we've now got 2 positions here and here which are really, really close to each other. So what we've effectively done is kind of got in at the same place but with 2 positions. We've doubled our initial entry. Yeah. If we let it come down to here, there's a nice distance between those 2 entries, and we might have further entries kind of down here and another one down here. But we've planned to get in at these levels. If we start getting in every time we see a bullish candle, we'll get in there, it will come back down against us, we'll get in there, and now we've got 3 entries where we plan to only have 2. So our rate of drawdown is going to be vastly accelerated from what our initial plan was. So when we get down to this level and we were like, oh, I'll be comfortable with 500 drawdown here, we're not going to be in 500, we're going to be in 700 or 800 maybe, I don't know. But we're going to be in more than we've planned for. All right. So it's just a note which occurred to me the other day. I hadn't mentioned about the distance between your entries. So just make sure that you distance your entries. Make sure there's a good amount of pips between each one. Otherwise, you're going to find that your drawdown, your rate of drawdown is vastly accelerated. And this will only come with practice. Get yourself in the simulator. Practice this. See where you get in and see the levels and see how fast your drawdown accumulates with 1 position, 2 positions, more positions. Just practice in the simulator and get used to getting in and out of the market without a fixed stop loss. Just see what happens, and you'll get used to not wanting to get into the market too quickly. All right. So it's just a quick amendum I've put into this particular module because I realised I hadn't covered it in the last one. Okay, so the full or partial close. We have a bank of cash built up, okay? Over the last week, day, month, year, whatever it may be, we've built up a bank of cash. Our P&L has been getting greener and greener and greener every day. We've been banking more and more and more profits. And we've got a number of trades open right now that are in the red and they are hurting us, all right? So we've got in and we are wrong. In fact, I'm actually in this position now. I got in far too many New Zealand dollar trades last week. I was planning some fills back down to this propulsion candle, and I've been getting in all the way up here and getting out. I mean, I've banked a couple of £100 on this trade, but it's against me, okay? So my P&L at the moment I think is sitting somewhere in the region of £800. I'm comfortable with that. I mean, that's, to my account size, it's not really too much of a problem. But what I can do is I can start to reduce this. Okay, so what we do is we use our profit to offset against the open positions. So we use the profit to reduce the loss, but not fully remove it, as we are only temporarily wrong on the trade, remember. Okay, price will likely at some point come back and let us out, but for now it's too much pain for us to bear. So we've got 2 options. We can either close one full position that we have on a pair that is in too much drawdown, or we can close part of a position on a pair that is in drawdown. Okay, so the way that we do this is we look at the profit that we have built up today, this week, or this month, and we use part of it to reduce our pain and our drawdown rate. Okay. So you can use up to 50% of this profit you've made if you want to, but whatever will make you feel more comfortable in your trade. All right. So let's have a look at my current situation. Let's have a look at my positions. Okay. So I've got this 800 odd pounds drawdown on my account at the moment, and I've got a position here on the Euro New Zealand dollar, which is £145 in the hole. All right. So what I can do is, you can see I've already done this. These were 0.2s when I opened them. What you can do is I can either, let's say I bank £250, £300 today, all right? If I bank £300 today, what I could do is basically just close that order out completely, okay? Wipe it out, it's gone. So what I've done today is I've made 300, I'm going to take 145 loss, and I'm still going to make £150 today, but my drawdown rate and my pain level will be reduced by 1 position. Okay, so that's one thing you can do. You can take a full position off using the profits that you've made for the day or the week to reduce your pain, reduce the red in your P&L, and reduce the rate at which the drawdown will happen if that position keeps going against you. If your New Zealand dollar, in my case, if the New Zealand dollar trade goes against me, it continues to come down, my rate of pain, my rate of drawdown will be reduced because I've got less lot sizing on that particular currency. Okay, does that make sense? Okay, so what we can do is we can remove an entire position. The other option we have is we remove part of a position. So we can double click on our trade, okay, and we can say, right, just close out 0.4 for me, okay, of this position and take a partial loss. So let's have a look at a full position I've got on. So in Euro New Zealand, I've got 0.2 on here, and it's, so let's say, for example, let's round it down to 100. So this is £100 in drawdown with a 0.2 position. So what I can do is I can open this up and close out 0.05 of this. All right. So what's that going to do? That's going to close a loss of £25 on this position and leave 0.15 running. And that's exactly what I've done on this one, I've done it twice on this one, and I've done it 1 and a bit on this one already. Okay. So what I'm doing is I'm using my profits, and this is what I did on Friday. Okay, you can see I made £213 profit, but I've got a negative pip count. A negative pip count is caused because on Friday I reduced the pain by taking some losses on these particular pairs. All right. In fact, what we'll do, let's go. So I've just gone into my account history here and just sorted my P&L by time. So I was getting a bit of a mess with that. So you can see here the Euro New Zealand trade. Okay, I took a 0.5 loss on that Euro New Zealand trade. Okay, so this is live position at the moment. I've got a buy here, I've got a buy here, I've got a buy here, buy here, and a buy here. So you can see price has moved against me. Okay, and I've been wrong on it. Yeah. So I decided on Friday to reduce this, which was a 0.20 lot, down to a 0.15 lot. All right. So I took a loss of 17.61 on that Euro New Zealand. All right. Euro New Zealand's here. I took another loss on it. Okay. So this one here, which was a 0.2, I reduced it down. Okay, by taking a loss of 33.19 on it. Yeah, so I've taken basically a £60 loss there on these two positions. But the reason I've done it is not because I'm not confident that price is going to come back up to these levels. I am, because we've got a gap here which I'm pretty sure is going to get filled at some point this week. But the reason I took these losses is in case it comes back down and retests down here again. Okay, and you see I've got a pending order in just in case it does. The rate of my drawdown is going to be reduced by more than 0.1, so it's 0.11 lots less my drawdown is going to be happening at than it would have done if I'd have kept those on. All right, and one of the reasons I reduce my drawdown rate is so that I can get into the market with more positions. You'll find that when you've got a couple of positions against you in the market and you're sitting in drawdown, it doesn't so much knock your confidence, but it makes you less inclined to take new trades because you're worried about what's going to happen with those trades. So by removing some of that worry, that uncomfortableness on the trades that aren't working, it allows you more confidence to get into new positions. All right. And I knew that I was going to have to hold these over the weekend. And what I wanted to do was on Monday morning, not get up and think, oh, I've got £1,500 worth of drawdown. I'd rather start with £700 or £800 worth of drawdown and look at getting into some new positions, because these new positions I'm going to use to make profit, which is going to pay for these if they're wrong. All right. And you keep repeating this process. So you keep removing these negative lots, all right, and taking small losses in your account, when you need to and when you feel you're getting uncomfortable, using the profits that you gain, right? Now, you're going to say, but what happens if I don't bank any profits? You are going to bank profits. We're in lots of different pairs, remember. Some of these, not every single one of these pairs is going to go against you. I mean, it might do. You could get into a massive squeeze on every single pair. You've got to be really, really wrong and not paid attention to anything I've said in this course if that happens, okay? If you're getting into a position where every single trade you're taking is going into massive drawdown with multiple positions, we need to go back to module 1, start again, okay? Come in the live room, talk to me about it. Let's have a look at your P&L, look at where you're getting in. I'm happy to go through that with you guys. It's good learning experience to look at people when they get into big drawdown situations. It's very, very rare it happens if you're trading correctly. Trading when the RSI is above 68 and 32 only, yeah? Just do that. It's very unlikely you're going to get that wrong every single time. You're going to bank profits, okay? You're going to continuously have positions going into positive territory for you, all right? I've got a CAD Swiss at the moment on, yeah? It's in positive territory. I don't know how much profit I've got in there, but basically if this gets down to here and I bag £112 or whatever the profit is in this, £108 on this trade, I can use part of that to wash away a little bit more. I could wash another £20 off, another £30 off a position that's in drawdown if I'm uncomfortable still, right? But what I would hope is that CAD Swiss, when it gets down to there, is made me a nice £108 profit, and these two positions have turned in my direction and come back down to somewhere around here, and this drawdown's sitting at £300. Why would I wash away that? It's going in my direction. What I thought was going to happen, i.e. come back down and fill this gap on this propulsion candle, is playing out. If something's playing out, I'm not going to start washing away my profits. I'm not going to take losses on positions that are in drawdown if things are going in my direction, all right? So let's have a look at what happens when we are really wrong. The big squeeze, as I call them. So squeezes will create losses. Now, a squeeze basically is, you might have had the terminology, a long squeeze or a short squeeze. Basically what a squeeze is where price is moving really, really hard in one direction. We call it a trend, but it's a continuing trend that doesn't show any signs of letting up anytime soon. It just keeps going and going and going in one direction. Every now and again, you will get squeezed really hard like this. Now, the situation I just showed you with the New Zealand dollar at the moment, that's not a squeeze, okay? That's going up and down. So you can see with the New Zealand dollar, I mean, it's coming down and it's now starting to move back up. I'd expect it to move up. Let me just grab my drawing tools quickly. So yeah, so you can see this is moving down, okay? We would expect it now to probably come back up into a bicycle. That's what I'm expecting to happen. This is not a squeeze. This move here is not a squeeze, all right? I'm in what, 1, 2, 3, 4, 5 positions. What I would class as a squeeze is where you've got into the market, it's gone beyond the initial plan that you had, and you've gone 2 or 3 more positions into it and it's still going against you. That is a squeeze. It very rarely happens, but it can happen, okay? And you need to be aware of it and you need to be prepared for it. So every now and again you're going to get squeezed really hard, and this is one reason why we do not use big lot sizing. We split our position, our 1%, 2%, 3% risk, whatever you want to take on that currency, we split it down into lots of small positions, small lot sizes. So if price does go against us, we've got time to look at it, figure out what we're going to do and how we're going to get out of that position that we're in a squeeze on, by using other profits to remove these losses, okay? Squeezes are typically due to some fundamental reason which just makes price accelerate away and not look back. Prime example, coronavirus, okay? That's a squeeze, right? In March, lots and lots of currencies got squeezed and squeezed really hard. If you were in the wrong side of the coronavirus, you would have got hurt. Yeah, you may have even blown an account. I don't know. Lots of people probably did, but those sorts of things are squeezes, and they very, very rarely happen. Okay, so you just got to be prepared for them when they do. And we've got a way we can see here with drawdown control of getting out of these squeezes by washing away small losses constantly from our account using the profits that we that we gain, okay? It will reverse at some point, but for now our positions are negative and getting more negative by the hour or the day, depending on the time frame you're trading on. This will hurt and you will not be able to see a way out, okay? And people panic when they get to these levels. But the reason you're panicking is because that currency that is getting squeezed, and it typically normally happens to a currency, not multiple currencies at once. That currency that you're on and getting squeezed on, you're over leveraged on it, or you've got too many positions, okay? Now you're going to take a loss, okay? And it could wipe out an entire day or even a week's worth of profit. So let's say, for example, in my case at the moment, these New Zealand dollar trades go against me, right? And they keep on pushing, they keep squeezing, and I'm getting wronger and wronger as the time goes on, okay, over the next week or so. What I can do is shut the whole lot out when it gets to £2,500 in drawdown, for example. What have I lost? £2,500. What have I gained over the last month? I've gained 2,800 this month already, and we're only on the 16th of the month at the moment, all right? So I'm looking to make 5, 6, 7,000 a month. If I have to take a £2,500 loss because I'm really wrong and getting squeezed and I can see a fundamental reason why this thing may not turn around, I can get out. Worst case scenario, I'm going to take a loss but still make a profit on the month. What's the number one rule I spoke about in the previous module? Capital preservation. If you don't have capital, you cannot trade. You're going to have instances in the future where you as a trader need to make hard decisions. No one likes taking a loss, okay? But sometimes you will get squeezed and you will want to take a loss. And when you take that loss, it'll be like the world is lifted off of your shoulders and you'll be able to breathe again. One of the reasons I personally don't trade gold or indices, like the S&P 500, DAX, those sorts of things, is because in the past they have hurt me extremely badly. Gold has got a history of running away and just going. It'll just go from one direction and it will keep going and going and going and going. And no matter how much you scale into that position, knowing it's going to come down, it goes against you. And I've taken some £1,000 losses, £2,000, £3,000 losses on gold because it's just gone so far against me. I thought, I don't want to be in this. I'm not enjoying trading and I'm seeing my profits just eaten by my gold positions. So I shut them. The next day, I was a happy trader, I slept well, and I started getting back into the market again, making profit. And I just got out, okay? You're going to take losses. The thing you've got to think about is at the moment, you're taking losses every single day. You're taking 2 or 3 or 4 trades every single day, and you're taking losses because your stop loss is getting hit, all right? What's that doing to you? It's doing what gold did to me a few months ago. It's hurting me. But I got hurt once 2 or 3 months ago. I can't remember when it was. You're getting hurt every single day because you're getting into positions, you're getting them wrong, getting stopped out, getting in again, getting stopped out, and it's driving you mad, okay? This way of trading with small lots is comfortable, it puts profit in the bank every single day, and yeah, you're going to get squeezed. Look at squeezes like the loss that you took this morning, yesterday, or the day before when you got it wrong, okay? Squeezes are going to happen every now and again, but they're rare, all right? But you will be okay because you've bagged so much money, you can afford to take these losses, okay? This will happen more if you over leverage and you use too big of a lot size, okay? Okay, so let's have a look at a squeeze. Let's go to a US dollar pair, US dollar CAD for example, and we'll pop back to a daily chart. Okay, this is a squeeze. All right, so let's mark this out on the chart. So it started here. Okay, coronavirus running wild. Now the important thing to note here, let's put it in yellow. What happened in this squeeze? Went up. What happened? Came down. Why did it come down? What have we got here? A gap. Okay, we've got propulsion candle here, which was traded inefficiently on the daily chart. Okay, this part here. It's got to come back and it's got to fill. What do we get here? Propulsion candle. I'm going off on a tangent now, but we've got a propulsion candle here, yeah? It's come back up. What's it done? Traded into that propulsion candle, filled this gap, moved back away. All right. So what goes up must come down. And the reason it must come down is because we'll have an inefficiency in the market. So every time you get into a squeeze, look at your chart and think, is there an inefficiency here? An area of imbalance that we've got to get back to and fill? Have the banks balanced their books? Are they happy to continue off in this direction? If not, they're coming back here. We don't know when they're coming back here, but we know they're gonna come back here. All right, let's drop down onto the H4 chart and have a look at this in a bit more detail. So this is the squeeze, right? We've got this beautiful big candle here. Look at this lovely shooting star candle, and we had the RSI way over the 68 level. It was almost up at the 80 level. Okay, so we'd have taken a short here, right? Wouldn't we? We'd have taken a lovely short there, thinking, yeah, it's coming back down. It's going to fill this gap. Definitely, it's coming back down to fill this gap. What did it do? Didn't fill that gap. Pushed up against us. So we'd have put a pending order at the top of this because we'd have thought, well, maybe they'll pull up, they'll sweep the highs and come back down. They didn't. They pushed up higher. So we thought, okay, right, well, we're wrong on this one a couple of times. Let's have a look at the next turning point. We would have looked left. Probably not seen anything in this case because obviously it's so far back. But let's say we got in when we saw price sweep these highs and put these lows in, these couple of candles here, down candles. We thought, yeah, they probably come up and swept these, and now we're going to turn down and fill this gap. Didn't happen. Pushed on higher. Beautiful bearish engulfing here. We got in there. Nope. Still carried on pushing higher. All right, so we would continue to get in possibly on these trades, bearish engulfing there. So we would probably seen this stop hunt happen here above that H4, and we'd have got in on this one. Yeah, and at some point it turns around and it comes back down and gradually moves in your direction, right? But it didn't fill this gap for a long time until here. Okay, so what's this? This is the 3rd of June. It filled the gap. The gap started in March, April, May, June. 3 months. Okay, you were in drawdown on this trade for 3 months, but what happened? It came back in your direction. Always will come back and fill these gaps and these propulsion candles that you'll see. All right, so when we got to this level here, we'd probably be thinking, yeah, I'm in a bit of pain here. I'm not happy. And then when it moved against us, we'd be like, right, okay, I'm really wrong on this. This doesn't seem to be turning round. So we would be then looking at the profits we've made on our other positions, and we'll be looking to get rid of these. Okay, so we'll start getting rid of these positions. We'll be removing parts of them or whole ones of these to make ourselves happier during this squeeze that we're in. Okay, if we've come in with very small lot sizing in this squeeze, we may not even get worried. Okay, if I'd have entered with 0.5s here, for example, on a £10,000 account, I'm probably not going to be that worried. Let's put a, where's the price at the moment? Make sure I'm not in the right area. Let's put a pending order in down here. So this side got in here. Let's put a stop in. and move that stop. So up here, we would be £288 in drawdown on this position. So on this position here, let's say for example I was happy to have 300 drawdown per position I entered, because I've got a 30, 50, 40, whatever £1,000 account, I may not even have got out of this. I might have just sat in that going, yeah, I'm wrong, I'm wrong, I'm wrong, I'm temporarily wrong, I'm really temporarily wrong, but I know it's coming back down. So you may well have stayed in this position, you may not. If you'd have gone in with a 0.2, you'd probably be out of this now, because you'd be 4 times the size of that. You'd be 1,000 in drawdown. You wouldn't let it get to 1,000 in drawdown. You'd have scaled out the position by then. But you see what happens with squeezes. Even squeezes will retrace. Okay, just be aware that they will happen to you, but be aware that they will come back. Now, another thing I want to point out on this particular squeeze is we got in short here, okay, and then we took another short here, okay, when it swept this high. Look what happened to price. It came back down. Now, our first entry is here, our second entry is here, so our average price on this trade, okay, is going to be in the middle, right? There. Look where it came to. We had an opportunity here, if we wanted to get out at break even. So another thing you could do is, if you're unhappy about a trade and you think, I really don't like the way this is going, you'll always get opportunities to come out of it at break even. The other thing you can do is, when this pulls back, you could take profit on this trade, take this 80 pips, yeah, and cancel out half of this trade, just in case you're wrong. Okay, so you could take maybe, I don't know, an £80 profit, let's say, on this move down, and remove £40 of this loss. So you'll net 40 in profit and a much smaller amount of drawdown. Now when it comes back up against you here, I mean, it just did not give you an opportunity to get back in. But when it came up here and tanked, this was in profit, this was at break even. You could have used this profit to wipe away this trade, get out, and you've not lost anything. Okay? So even in these big squeezes, all I'm trying to say is you're going to get them every now and again, but they will always come back in your direction. When a squeeze happens, it tends to be fast and violent. Fast and violent moves leave propulsion candles. Propulsion candles need to be traded efficiently, so the market will always try to come back to them. Okay, so that's squeezes. So we've had a good look at a squeeze. What happens in a squeeze? Be prepared, they will happen to you. I'm there to help in the live room if you get into a squeeze situation. It's rare. I'd probably get squeezed to the point where I'm feeling very uncomfortable once or twice a year. Okay? If you're trading efficiently, or you're trading with good targets at levels that make sense, you're not going to get them very often. And when they do come along, we deal with them, we take a loss, all right? But isn't it much nicer to be banking profit on a daily basis and knowing that you've got a big bank of money there, so that if it does go wrong, you can go, wow, I'll get rid of half of the money I've made and still make a load of money. Are you profitable at the moment? No, because you're watching this course. If you had 5,000 banked and had a 2,000 loss you had to take, are you profitable? Yes. Okay, that's our goal as traders, consistently profitable. All right. Homework. Another short module. Hey, homework. Go back in time on your chart and look for some big squeezes. All right. So look at the similar to the example I've just shown you. Go into the daily chart and look for some really strong trends in the in a particular direction. And then drop down onto H4 or to H1, highlight that area and see what would have happened. See how many times you could have got out of those squeezes if you'd have got in. Did it retrace enough to get you out with a profit on some of the trades you may have taken? Give yourself a bit of confidence that when a squeeze happened, it doesn't go straight up in one direction usually. It will have pullbacks in that squeeze, and those pullbacks we can use to our advantage to make profit and wipe away some of the negative positions that we're stuck in. All right. So go back and have a look at those situations, see how often they happen. See if you would have got out with a scratch or if you would have blown your account. If you'd have blown your account, do this in the simulator, okay? Do this in the simulator. It's a great thing to do. Find a squeeze, go back in the simulator to that time and actually trade it. Trade it in the simulator with Sphere Tester, right? See if you'd have blown your account, okay? If you'd have blown your account, have a look at your lot sizing. Reduce your lot sizing by 50% and do the same thing again. Would you have blown your account the second time? Probably not. So what lot sizing should you have? If you want to survive a squeeze and never get to a point where you're getting uncomfortable, you can do that. You just need to reduce your lot size to a level where you think, if I get squeezed by 2,000 pips, I'm still going to be comfortable and I'm still going to have a way out of it. All right. Make yourself think seriously about lot sizing and whether you want to be comfortable and sleep well at night or be aggressive and take one big hit. Okay. I like to sleep well personally, so I keep my lot sizing at a decent level that I'm used to and I know I'm comfortable with. I've got friends that trade in this way as well, okay, and some of them trade with big lot sizes. All right, I've got a friend who has an FTMO account. He trades mainly SPX, S&P 500, which I don't touch with a barge pole, but he trades it on M5 and M15, and he's kind of scalping basically. And he will make £1,000, £2,000 a day. He works in dollars actually. He makes a couple of $1,000s a day, right? He builds up really big pots of money. Okay, so we're talking 10, 15, £20,000 a month he's making easy. All right. Every now and again he'll lose his FTMO account. Boom. He'll just lose it. Right. He'll go and get another one. Okay, and he'll build it up and he'll take loads of profit out of the market and he'll lose it. Bang, lost 5,000, right? So what happens is he makes these big hit months where he's banking loads and loads of money. He's sitting on a pot of 100 grand and then he'll take a big loss and he'll lose 10, lose 15, lose 20. He'll lose pots of money. But overall, long term, he makes money, and that's the way you need to look at it. So you can trade aggressively, okay? Trade with big lot sizes if you want to. Just be aware that trading this way with big lot sizes, you're going to blow an account here and there. But if you blow an account here and there, if you've got a 5 grand real money account of your own money that you blow 2 or 3 times a year, you've lost 15 grand. If you can make 5 or 10,000 a year, you're way up. Okay, that's what it's all about, being consistently profitable. We're going to take hits, we're going to take losses. All right, get used to it. Be used to being in drawdown. It's perfectly natural and normal. All right. Okay, so both of these can work. Your psychology and your risk tolerance is what's going to decide. All right, so go and have a play in the simulator. Get a £10,000 account, £50,000 account, whatever you want, and go and play with lot sizing. Get used to it. Do drawdown control, all right, in Sphere Tester. So when you take some profits every day or every week, whatever you want to do, wipe away some of those losses in Sphere Tester. Do partial closes in Sphere Tester. It can do that. You can do it, okay? Yeah, so get in there, have a play around. If you want to just get in and out the market with the RSI and the order block breaker, use some other system, doesn't matter. You may well have looked at Module 7. If you have, you know some of my entry strategies, so you could use those. But if you haven't yet, just go and use whatever system or strategy you want to and get into the market, get into trouble, and wipe away losses using your profits. See how it can be done. See how many positions you can get into badly and get out of. Give yourself confidence that drawdown control works. All right. That's the end of this module. Next module is Module 7. If you haven't skipped forward to Module 7, well done. If you have, you know what's coming. Okay, we're going to look at next the entry criteria I use, how I get in and out of the market. All right, so basically the systems. Okay, so go and do some testing, anything you want covered in the course that you haven't quite grasped, go back and have another look at it. And next is module 7, final module of the course, and we're going to look at my entry and exit criteria.